All right. Good morning, everybody. Good morning, all you magnificent melonheads of the world. Happy Thursday, everybody. Today is July 16th, 2026. Once again, this morning, we've got to talk about South Korea. South Korean stocks, another big volatile move yesterday. And this morning, South Korean regulators are taking steps to try to rein in levered ETFs. Why are they trying to rein in levered ETFs? Probably because the volatility is freaking exploding in South Korea. And why is volatility exploding? Because everybody, literally freaking everybody, is piling into the same two stocks and or levered ETFs made up of those same two stocks. South Korean retail traders, locally referred to as ants, have put everything they have into those two names, including cashing in life insurance policies and taking out bank loans in order to buy these stocks. If only we have some historical examples of situations like this not ending well from which to draw upon that past experience and, maybe avoid making the same mistake again. But you know what? Just pile into the most crowded AF trade in the history of humankind and hope for the best, right? I mean, that's what I'm just a doomer, right? What do I know? So let's talk about this volatility, right? And why the South Koreans are halting new filings for levered ETFs and why they're putting limits on the kind of accounts that can trade them. So in all of 2024, the entire year, on one occasion, we saw the KOSPI index make a move of 5% or more in either direction. It was really only on that August 5th yen carry trade panic in 2024 was the only time that the KOSPI index moved 5% or more in either direction. In 2025, it did it twice. In the lead up to, or in the immediate aftermath of Liberation Day, and then on Taco Tuesday after they backed off on the tariffs. So we had two moves of 5% or more in either direction in 2025. In the first 6.5 months of 2026, the KOSPI index has made a move of 5% or more in either direction 29 times. All right. Once in all of 24, twice in all of 25, 29 times in the first half of this year, including in July, 6 out of just 10 trading days thus far this month, and we're only halfway through the month. Yeah, you think things are getting a little volatile? Hey, do you guys remember back in January when silver and gold were going vertical? And I was warning, a lot of people accused me of being a downer. I had some people even accuse me of working for the comics, which is freaking adorable considering the origins of this channel. I was warning people, I'm like, guys, this is fun to watch, and I own a lot of metals. It's nice to watch number go up, but this volatility is not good. Something wicked this way comes. I kept saying, I want to see silver just trade sideways, maybe up and to the right slowly. I don't want to see day in and day out 5 to 10% moves. And lo and behold, within a couple of weeks of those warnings, the price of precious metals absolutely collapsed. Silver dropped by like 50% from its highs, gold about 30, 40% of its highs, because big swings in volatility are an indicator that the buyers are running out of steam and that the sellers are starting to wrestle back and forth with those buyers. And sooner or later, the sellers regain control, especially when there's nobody left to buy. And we're going to see in this article in Bloomberg, there is literally nobody left to buy. Freaking everyone in South Korea has already piled into these names. And also, again, I got to make a reference to the movie Margin Call. It was the fact that all of the risk models at that firm in Margin Call were based on volatility limitations, assumptions about volatility that didn't work anymore. And when Zach Quinto's character realized, hey, we've broken those volatility thresholds at 4 or 5 times in the last week alone, and then he goes and he plugs in new volatility metrics into those algorithms, and they realize, oh crap, our firm is already dead. We haven't figured it out yet, triggering the fire sale and all those meetings in the middle of the night. It was a great movie. This is exactly what is happening in South Korean stocks right now. But again, I'm just a doomer. Meanwhile, United Health stock is ripping this morning. Big beat and raise from United Health. That's also the biggest weighting in the Dow index. So the Dow is up big on that news. United Health is using AI to rein in costs, and that is just delightful. Isn't it comforting to know that when you need an MRI or some procedure done on your knee or whatever, instead of some emotionless, callous receptionist telling you no, you're going to have a chatbot tell you no, and it's going to save them a whole bunch of money. Okay, so we got that going for us. Taiwan Semiconductor profits have soared 77% year over year. They just reported their earnings, but the stock is down this morning because they announced a big increase in their CapEx. We've heard this one before, including another $100 billion for chip fabs in Arizona. I hear a lot about these foreign companies investing in domestic chip production here in the United States, but thus far, very little movement in those directions. Although, hey, it's an encouraging sign. We've got a hedge fund, King Street. This firm has $30 billion in assets under management, and they are restricting client withdrawals from their flagship fund that is made up predominantly of distressed debt, bankruptcies, and collateralized loan obligations. In other words, leveraged loans against things like commercial real estate and businesses with bad credit ratings. Yeah, gee, if only somebody had been warning about those asset classes for the last few years. What else we got? Ukraine. Okay, we've been talking a lot about the Ukrainian drone attacks over the last few days and the devastating effect they've been having on Russian tankers. It's also important to note that the Russian retaliations for those tanker strikes, the Russians are once again targeting Ukrainian export infrastructure with their cruise missile barrages, which are substantial. And despite a deal that was cut in 2022 to allow food exports to prevent a global starvation, the Russians have once again started targeting those export facilities, in particular around the Odessa region. Ukraine has lost 1/3 of its grain export capacity in just the last couple of weeks, and wheat prices are approaching their highs that were last seen in January of 2024, rising rather rapidly, but still well shy of the limits or the levels we saw back in 2022. But it just goes to show you that targeting of infrastructure and shipping, it's not just a Ukraine story. The Russians are doing it too, although it's not quite as devastating as what the Ukrainians are doing to Russian energy infrastructure. But that door does swing both ways. We've got a curious story about Hyundai buying a stake in robot maker Boston Dynamics from SoftBank. And I have got a lot of questions about this story. The numbers just don't make sense here. The valuations for Boston Dynamics are all over the place. Just how desperate for cash is SoftBank? And is there circular financing round tripping going on here? Because how much of Boston Dynamics sales are coming from Hyundai, who just bought them at a curiously low valuation? We got the United States has put 25% tariffs on everything we buy from Brazil, immediately followed by exemptions for everything we buy from Brazil. That's a funny story. We'll take a look at that one. We've got Alcoa is building a gallium plant in Australia with backing from the governments of the United States, Australia, and Japan for this factory. That is a rare earth and a defense story. Gallium, the primary use for that besides semiconductor manufacturing, but gallium is also used in modern radar, including the radar seekers that are attached to missiles, anti-ship missiles. Even if they're GPS guided, there's a radar seeker that takes over the last few miles to make minor course changes. So gallium is vital to the defense industrial complex, and you got the governments of 3 countries backing this new factory because 80% of gallium production globally is in, you guessed it, China. And last one of the day, stick around to the end. We've got a former Federal Reserve official is going to jail. You'll never guess why. Stick around to the end of the show for that one. But first, we must shrink my big melon of a head, and let's see what's going on in the world of finance. Don't forget that like button and that subscribe button for the YouTube algorithm, so you can come back and have your coffee with us melon heads, because we do this every business day. The S&P 500 is in the red this morning, down 23 points or 0.31% in the red. The Dow, though, is up 31 points or 0.06%. Now, we had a big gap up at 5:55-ish a.m. this morning. That was United Health reporting their earnings. The whole index was taken higher by that. I'm not really sure what happened at 7:45. I went looking. I couldn't find anything specific to explain that sudden drop at 7:45. And now we've given back about half the gains that the Dow took from that United Health report. And looking over at the NASDAQ ahead of the opening bell, down at 258 points or 0.87% in the red. Some South Korean volatility contributing to the selling in tech this morning. Looking over at the U.S. dollar, we're higher by 13 basis points at 100.65 for the Dixie. The bond market, we've got some decent moves going on in bonds this morning. The 30-year yield is higher by 4 points and change, 5.125% for the 30-year yield. We've got the 10-year is at 4.587, higher by 4 points and change, still just shy of that 4.6 level that it's been flirting with for a couple of weeks here. The 2-year yield is at 4.172, also higher by 4 points and change. And the 1 month is down by a fraction of a point, 3.695%. Looking over at commodities, we've got spot gold is lower this morning by $76 at $3,984, back below $4,000, 1.9% lower. Spot silver having a rough morning here, $55.60. That's lower by $2.13 or 3.7% lower here. I didn't see anything specific to precious metals going on this morning. We do have a stronger dollar and slightly higher interest rates that would put downward pressure on precious metals, but the move in silver is a little bigger than I would expect, considering it's only a 4 basis point move in the 10-year. So I'll have to keep an eye on silver today. Not looking good, though, but I still like the shiny. And remember, guys, the volatility. Again, that's a key point today, is that volatility is a warning sign that the top is near or already in. Remember, we saw a lot of that back in January with precious metals. Copper higher by 0.5% this morning. Platinum higher by 0.75% this morning. Palladium down 1.75%. And crude oil is up about 87 cents here at 1.1% higher, but still right around $80 here at $80.47 for August WTI futures. Looking over at Bitcoin, a little bit lower this morning, $63,974. That's off by about $740. It's priced on Coinbase, although we have had a pretty good couple of days. We had that big bump up in Tuesday on the heels of the lower than expected CPI that took us back up to about 65,000. We're down off those highs now. Looking over, okay, this is the big one here. South Korea to halt new listings of single stock leveraged ETFs. South Korea will temporarily halt new listings of single stock leveraged exchange traded products to curb market volatility after a surge in popularity of funds tied to Samsung and SK Hynix. The ban will remain in place until market conditions stabilize, the Financial Services Commission said in a statement on Thursday. Authorities will also raise the minimum deposit requirement or minimum count balance in cash required for leveraged ETF trading to 30 million won, which is about $20,300, up from 10 million won, expected to be implemented on August 5th. So they are more than tripling the minimum amount you need to have in your account to play with these things. Why would they do that? Because small investors are getting their clocks cleaned, absolutely destroyed in these names, which are down significantly from their highs we saw just a few weeks ago. And the volatility is killing them. And keep in mind, guys, when you have these big moves up and down, these levered ETFs, losses are more powerful than gains. So down 5% one day, up 5% the next day, these levered ETFs lose big money, even though it seems like a similar move. The losses pile up faster. Plus, you've got the time decay because all of these levered ETFs are using derivative instruments that typically have some form of contango or time decay attached to them. So they're taking steps to kind of push unsophisticated traders out of the market. Do I like that? No, I don't like the government telling me what I can and can't invest in. Do I understand why they're doing that? Yes, because the Koreans have gone cuckoo for Cocoa Puffs in these stocks, and they're putting everything they have up to and including selling their kids' freaking kidneys in order to buy this stuff. And now they're all getting wiped out. The measures mark Seoul's most comprehensive effort yet to cool a retail trading frenzy that's transformed the $4.1 trillion equity market into the world's hottest and also one of the most turbulent, announcing after a meeting of regulators, finance ministry officials, and central bankers, the rules follow growing worry that leverage ETFs tied to Samsung and SK Hynix are causing excessive market swings. You think? 29 days so far in the first half of this year of 5% or more swings in either direction. Yeah, you think maybe there's some excessive market swings going on there? The products were initially launched domestically as they were rapidly growing overseas, and we judged that local investment is necessary to enhance the appeal of Korea's capital market, FSC Director General Byung-ji Ho told reporters late Thursday. But since then, equity market volatility has increased. And South Korea is looking over at the United States and saying, "You all right? I learned it from watching you." You know, the old Just Say No commercial of the 1980s. Yeah, we do this here too. We have a ton of these silly leveraged single stock ETFs that retail traders just can't get enough of here in the States. But they took it to a ridiculous extent in South Korea. Just how bad is it? Well, it's funny. You should ask. The products, along with the two chip makers that they track, have become so popular that they now account for more than 70% of trading value after attracting a flood of retail money. Foreign investors, however, have grown increasingly cautious, selling more than $100 billion worth of local shares this year alone. All right, so it's bad enough that the index itself represents, or 50% of the index is represented by just two stocks, Samsung and SK. But not only that, but 70% of all stock trading in the whole freaking country is either these two stocks or the levered ETFs that track them. All right, guys, this is the definition of a crowded trade. I don't know that there has ever been a more crowded trade in history than the South Korean memory names are right now. And as this is going on, as these South Korean, the ants, the retail investors are piling into these stocks, foreign investors are dumping into that, taking the money and leaving. And if you look at what the KOSPI has done for the last few weeks, those foreign investors selling have won the tug of war over price. Look at the decline here, down something like 30% from the highs that we saw just in the middle of June. In a month, the KOSPI index has gone from a high of 93.85 down to its current level 68.20, which last night was down 6.4%. Another big swing. 6 of the last 10 trading days, just this month alone, 6 of the last trading days, 5% swings or more in either direction. And look, you know, if only we've seen charts like this end badly, right? Hey, maybe the bottom is in. Maybe we go up from here. There's a lot of these AI bros in the comments when I posted something about this last night on X. They're all like, "Oh, you're just a perma bear. Everybody's getting rich buying these stocks." Nope. No, they are not. They wouldn't be putting these limits on the levered ETFs if everybody was getting rich. Everybody's getting broke off of this stuff right now because they all piled in up here. And let's see, if you're in a levered single stock ETF, that's like 3x the move of the underlying stock, and the underlying stock goes down 30%. What do you think happens to that levered ETF? It goes bye-bye. Guys, be careful. And again, this entire move, this South Korean move, understand it is 100% predicated upon the build out of AI data centers in the United States. This is the AI bubble. It's going to destroy South Korea. It's going to wreak havoc here in the States, but South Korea is going to get absolutely demolished when this thing goes. And you could argue, looking at this, that it's already starting to go. Meanwhile, United Health blows past estimates, hikes earnings outlook as it reins in costs. Oh, that reins in costs. That's just got to be good for you and I, right? United Health on Thursday posted second quarter earnings that blew past estimates and raised its full-year profit outlook as the company better manages high medical costs and uses AI to help streamline operations. The largest private insurer in the U.S. said it expects 2026 adjusted earnings of $19.50 to $20 a share. That's up from the previous outlook of $18.25 a share. United Health is maintaining its full-year revenue guidance of greater than $439 billion. But CFO Wayne D said in an interview that he expects the company to do better than that given the second quarter beat. Still, he said medical costs in the quarter remained elevated over historical levels, an issue that has dogged the broader insurance industry for more than 2 years. These results are not a reflection of a trend bending or coming under control, but rather our efforts to start pushing down what is already an elevated number, DeVite said. In other words, they're rejecting more people for procedures. Company reported EPS of $6.38. It's adjusted, of course, versus $4.90 expected. Revenue of $112 billion versus $110.8 expected. Company stocks up 7% pre-market. DeVite said the company is using AI to improve both efficiency and patient care. For example, AI is helping speed up processes like prior authorizations and improve payment accuracy by detecting potential fraud, waste, and abuse. Yes, they are using AI to automatically reject you for things. Isn't that just great? They used to have to pay some nasty lady $15 an hour to run a call center to reject you. Now they just have the chatbot do it. Wow, what an incredible innovation we have. You ever try to get an MRI authorized? It is just a lot of fun. And it's getting even worse. But hey, United Health stock is up 7.7%, $450.81 ahead of the opening bell, up by $32 this morning. That is largely responsible for the move we saw in the Dow. Let's temper that, though. It was a year ago that this stock got absolutely clobbered. There we go. Middle of 2025 when we had the whole assassination in the street thing, followed by all kinds of investigations that really tanked United Health. The stock has now recovered about half of the losses from that unfortunate episode. And we also got earnings from Taiwan Semiconductor this morning. TSMC to invest an additional $100 billion in Arizona after second quarter profit soars 77%. Very impressive numbers by Taiwan Semi this morning. Taiwan Semiconductor on Thursday reported a 77.4% jump in second quarter profit year over year, soaring past estimates as the world's largest contract chip maker continues to set consecutive record-breaking milestones. Here are Taiwan's second quarter numbers. Revenue was 1.27 trillion new Taiwan dollars, or $39.5 billion US, versus 1.26 expected. So it's a narrow beat on revenue. But look at net income, 706.5 billion Taiwan dollars versus 632 expected. Big beat on net income. That means margins are blowing out at Taiwan Semi. The company forecasts third quarter revenue between $44.6 and $45.8 billion, with operating profit margins of 56% to 58%. AI-related demand continues to be extremely robust, said the chairman. TSMC will invest an additional $100 billion in Arizona to meet strong customer demand, bringing its total investment in the state to $265 billion. It looks like it's that increase in capex that the market did not like, though. Taiwan Semi is actually down 3.8% here, $403.93, off by $15, almost $16 this morning. I don't think there's anything Taiwan Semiconductor could have reported that would have been good enough. I think the market was going to sell these numbers regardless. The stock was already up 40% year to date, 77% over the last 1 year, 257% over the last 5 years. I mean, this stock has been absolutely ripping. So there really is nothing good enough for a company like this. I mean, even ASML, which reported phenomenal numbers yesterday, the stock ended up closed up like 2% on phenomenal numbers, and now it's down 2% pre-market this morning. So it's basically traded sideways on amazing earnings. If that's what happens when earnings are great, what happens if they ever miss? Just throwing that one out there. Anyways, good day for Taiwan Semiconductor, although the stock doesn't quite agree. Meanwhile, King Street restricts client withdrawals from its hedge fund. This one broke yesterday afternoon. King Street Capital Management told clients it's significantly restricting withdrawals from its main hedge fund, moving investors who want to exit to a separate vehicle that will sell off the assets over time. You want your money back? No, can't have it yet. We're going to put you in a new box. And then in that box, maybe eventually you'll get something back. We can't tell you how much or what it's going to cost you while it's sitting in that box. The 31-year-old fund has struggled with lackluster performance, fleeing clients, and an exodus of long-tenured staff. It now manages less than $8 billion, down from $20 billion a little more than a decade ago. All right, that $8 billion, that is the fund in question. King Street itself manages over $30 billion in assets under management through various funds. This one that's gating withdrawals is $8 billion. King Street's move will enable us to manage and liquidate assets in an orderly fashion and to monetize positions at the most attractive exit points, founder Brian Higgins wrote Wednesday in a letter to investors. Investors will get a small portion of their redemption in cash sometime in the third quarter, a person familiar with the process said. The letter didn't say what fees they will pay or how long the firm will curb withdrawals, which clients can request quarterly. The shrinkage of hedge fund assets has forced King Street into other, less lucrative businesses. More than 40% of its $30 billion in assets under management is invested in collateralized loan obligations, where fees are more in line with mutual funds than hedge fund business that enriched King Street's founders. And again, if you look at what King Street is sitting in, distressed debt, bankruptcies, CLOs, leveraged loans from companies with lower credit ratings. This company specializes in buying debt from toxic companies that they think is undervalued. And what I think happened here is they bought a lot of this junk expecting a bottom in private credit and other credit problems, maybe even expecting interest rates to go lower. And then war broke out, and that isn't happening. Now interest rates are heading higher, if at all. And so this fund is gating redemptions. They're creating a new little box to put your money in if you want any of it back. And then they're going to sell it eventually for what, who knows. This is pretty much the same thing we're seeing in private credit. Meanwhile, Ukraine's Black Sea port loses a third of grain export capacity. The Farmers Union says, the title pretty much says it all here, guys. This is Russian ballistic missile strikes on the port of Odessa are really taking a chunk out of Ukraine's grain exports, much the same way the Ukrainians are targeting Russian oil refineries and Russian tankers. The Russians are targeting Ukraine grain exports. Ukraine is about 6% of global wheat production, and if they've lost a third of it, that means global wheat production, or at least global wheat reaching the market, is down by 2%. That is enough to send food prices higher in a market as deep and liquid as that. There was originally a deal was cut. Several other countries, including the U.S., brokered a deal where they all agreed we're not going to shoot at grain ships. We're going to let the food out so we don't starve people in poor countries. And, well, they're not doing that anymore. Wheat futures currently $677. I believe this is dollars per ton. Now, we are looking at monthly candles here. You can see down here a big monthly candle for the month of June, which is when this began. They've been pretty much trading at levels last seen in January of 2024, but still well below the obscenely high levels that we saw in early 2022 in the immediate aftermath of the invasion. But if they keep targeting this port infrastructure and if those Ukrainian grain exports continue to dwindle, we're going to see this number continue to move higher. Also, keep in mind the effect of fertilizer, right? Ever since the Strait of Hormuz has been closed, what's going on in Iran and in the Strait, that has limited fertilizer exports. That is also putting upward pressure on grain prices. All right, now we got to talk about this one in Market Watch this morning. I don't know what is going on here. Hyundai Motor deal with SoftBank for Boston Dynamics stake is as wild as the robots videos. SoftBank is selling a stake in Boston Dynamics at a valuation far less than what Hyundai values the robot's maker. And we've all seen these robot dog videos. Yeah, Boston Dynamics is the ones that make those. Hyundai Motor may have just struck an incredible bargain, or maybe SoftBank is hard up for cash. We know SoftBank is desperate for cash, but how desperate are they? The bargain or not is the robotic company Boston Dynamics, best known for those funky videos of robot dogs that appear on the internet every so often and scare everyone out of their mind. Hyundai on Wednesday said it will purchase the Boston Dynamics stake held by SoftBank after the Japanese company exercised a put option that it had as part of a deal initially agreed in 2020. Back then, Hyundai bought an 80% stake in Boston Dynamics from SoftBank at a valuation of $1.1 billion. SoftBank's stake, then 20%, has been watered down to 9.6% as it didn't participate in subsequent rounds of Boston Dynamics, whose Atlas won Best Robot at CES 2026. All right, so last year, Hyundai paid 89.1 billion won to increase its stake in Boston Dynamics by 0.3 percentage points, which implied a valuation of $20 billion for Boston Dynamics. That was last year. Analysts that cover Hyundai generally assign a valuation of Boston Dynamics even higher than that. HSBC's latest model, for example, suggests a valuation for the robotics company of $26 billion. All right, so Hyundai paid 20. The analysts say 26. So what did SoftBank just sell it to him for? That means that SoftBank is selling the Boston Dynamics stake at a valuation of some $3 billion. Wait, what? Less than an eighth of what HSBC analysts say it's worth? Less than a seventh of what Boston Dynamics or what Hyundai paid for it last year? What the heck is going on here? SoftBank only got a $3 billion valuation for this stake in Boston Dynamics. It's all the more fascinating because Hyundai is reportedly considering an IPO of Boston Dynamics as early as next year, which would have allowed SoftBank to exit, at least in part, likely at a much higher valuation. In May, analysts at Morgan Stanley estimated that a future Boston Dynamics IPO could potentially raise as much as 22 billion won, or about $15 billion. That said, analysts at Bank of America said there should be caution around a possible IPO, given the absence of top management leadership after the resignation of then CEO Robert Plater in February and limited visibility into its order diversification beyond Hyundai. So that's kind of the rub here. The CEO quit in February. So who's the new CEO? Why did the old CEO quit? And order diversification beyond Hyundai. So who actually buys Boston Dynamics product? It's Hyundai, the company that now owns them entirely. So what is Boston Dynamics really worth if the only people buying from them are the company that's also buying shares in the company? A little bit of circular financing there. Hyundai's now buying robots from themselves effectively. So if they do spin off the company, what's it really going to be worth? The valuations range from 26 billion to 3 billion. And why is SoftBank letting it go for so little? Just how badly does SoftBank need the money? Just how badly do they need to pump more cash into their failing bet in OpenAI? Apparently quite a bit. Anyways, we're probably going to hear more about this company. I don't know what the heck is going on here. Meanwhile, your comic relief for the day, U.S. announces a new 25% tariff on Brazil for unfair trade practices. Why is this funny? Well, we'll get to it. The United States plans to impose a 25% tariff on some Brazilian imports from next week after a year-long investigation concluded that the country had engaged in unfair trading practices. Skipping past all the Trumpian language and the deranged Trumpian syndrome language that fills up most of this CNBC article, I'm going to fast forward right to this part here that's very important. The tariff will apply to a host of Brazilian products, but will exempt certain major exports, including coffee, beef, avocados, Brazil nuts, petroleum oils, and aircraft parts, according to the notice published by the U.S. Trade Representative. In other words, we're putting tariffs on everything we buy from Brazil, but we're exempting freaking everything we buy from Brazil. Really, the only major category of imports from Brazil that was not exempt was steel. And we already have tariffs on steel. So what is this? This is just another stupid headline. Tariffs good, tariffs bad, tariffs right, oh, blah, blah, taco, this and that. This is another thing. It's like everything we did last year. We put these big numbers, we slap tariffs on things, and then we immediately start exempting our friends, start exempting certain categories, announce a 90-day extension, followed by a 30-day extension, a 15-day waiting period, a 20-day delay. Either do it or don't. Just pick one. Meanwhile, Alcoa greenlights Australia gallium plant with the U.S. and Japan, along with domestic backing. This is a rare earth defense story here. Alcoa said on Tuesday it has reached a final investment decision to set up a gallium plant at its Wagerup alumina refinery in Western Australia with backing from the Australian, Japanese, and U.S. governments and industry partners. The U.S.-based aluminum producer plans to construct and operate the plant, which could provide up to 10% of the global gallium supply, which would be pretty much 100% more of the global gallium supply than we currently control. This final investment decision reflects a shared commitment by governments and industry to strengthen critical mineral supply chains among the partners, said Alcoa President and CEO William Opplinger. Construction activities are expected to begin after final site prep, the company added. Gallium, recovered as a byproduct during the alumina refining process, is a critical mineral for the technology sector, especially the semiconductor and defense industries. And it is those defense industries that is very important here. Gallium is vital to radar, both radar on ships, radar on planes, and also the radar seekers on missiles. We need gallium for all of them, and gallium is almost entirely controlled by the Chinese at the moment. So we'll be building a gallium plant in Australia, hopefully sooner rather than later. And last one of the day, ex-Fed advisor, note ex-Fed, not FedEx advisor, which, like me and my dyslexia, I read this as FedEx like 10 times this morning. No, this is a former Federal Reserve advisor, gets over 3 years in prison for lying about China ties. Oh, that's good. That ought to speed us on our way to success. A former senior advisor to the Federal Reserve Board of Governors was sentenced to over 3 years in prison for lying to federal investigators about sharing restricted central bank information with Chinese intelligence operatives, according to the Justice Department. John Harold Rogers was found guilty in February of making false statements to investigators when he denied sharing restricted information on monetary policy, U.S. Attorney Janine Pirro said in a statement on Wednesday. The same jury acquitted him of the more serious charge of conspiracy to commit economic espionage. So somehow selling classified information to Chinese intelligence operatives does classify as, what is it? Sharing restricted information on monetary policy, but it doesn't classify as economic espionage somehow. John Rogers spent years secretly funneling sensitive Federal Reserve information to Chinese spies, then looked investigators in the eye and lied about it. And when that wasn't enough, he lied again under oath at trial, Pirro said. Rogers, a U.S. citizen who holds a PhD in economics, worked as a senior advisor for the Federal Reserve Board's Division of International Finance from 2010 to 2021, with access to non-public material on monetary policy and Federal Open Market Committee deliberations. This guy knew what the Fed was going to do before the Fed did it, and he gave that information to the freaking Chinese. Prosecutors argued that sharing advanced knowledge of Fed interest rate decisions could have allowed Beijing to generate enormous profits from trading its roughly $1.5 trillion in U.S. treasuries, according to the Justice Department. Rogers had allegedly begun a clandestine relationship in 2017 with Human Lee, a Chinese intelligence operative he met at a conference in China, and conveyed Fed information during meetings in Chinese hotel rooms held under the guise of teaching academic classes. He printed restricted documents before traveling to China, emailing material to his personal account after stripping classified markings, and forwarded sensitive information to a professor at Fudan University, the Justice Department release said. This guy didn't accidentally give up trade secrets at a vulnerable moment. No, he knowingly removed classified markings from documents, sent them to himself to get around company policy or Fed policy, and then gave them to the Chinese. Yeah, screw this guy. He received university professorships and financial benefits, prosecutors said, in exchange for his work. So he got paid. So the Chinese knew what the Fed was going to do before you knew what the Fed was going to do, before anybody else. And if they're selling, some guy's willing to sell this to the Chinese, you really think they're not selling this to hedge funds and big Wall Street trading firms? Remember, guys, it's a great big club, and we ain't in it. Gotta love the Federal Reserve. Maybe it's better if we just didn't have one. Just not have one. I'm just throwing it out there. You guys do what you want with it. Hey, I just want to say thank you, everybody, for having your coffee with us, Melonheads, this morning. Don't forget that like button and that subscribe button so you can come back tomorrow. We can do it all over again tomorrow morning. Thank you very much to my magnanimous Melonhead supporters on Patreon, YouTube members, and Buy Me a Coffee for supporting the channel. Links are down below should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.